What makes a firm different than another? And I think that's a big problem in our industry is kind of everybody seems the same. Who's a advisor, retirement planner, wealth manager, um, and the reason I use financial architect at our firm is because we build plans from estate planning, tax planning, retirement planning, Social Security, and so that's one. That's a huge component. That's kind of the umbrella of what we do. But really, when you get down to what people care about the most initially is their investments. And so, what I call the traditional portfolio, most of you have a pretty basic portfolio of stocks and bonds. I could look at you blindly and probably tell you what you own as a percentage of stocks and bonds. And it's usually somewhere to between 50% stock, 60% stock, and the rest bonds, 50% bonds. The problem with that portfolio is, number one, bonds have basically earned zero rate of return for a decade. So the bonds have been a big drag on your returns. But what's more important is that the risk that's in a portfolio like that. Now, advisors, brokers want to call that, a balanced, safe portfolio, and it's far from that. There's all these words that are used that make you feel secure that really, really you shouldn't. And so one of the basic things that we do that is very different is we call it beyond stocks and bonds. In 2008 is a perfect example. In 2008, every single asset class fell. We call it diversification. So let's say you're diversified. You own every sector, 100 stocks, whatever you own, a bunch of mutual funds, large cap, small cap, mid cap, value, whatever it is. I can tell you the average stock in 2008 stock fund lost about 30%. The market was down 37%. You had international and emerging, we were down 40%. The only thing that year that made money was bonds, and that was 5%. So that was carnage. If you owned a balanced portfolio of stocks and bonds, you lost about 30% at the lows. So my question to you is that acceptable? With the portfolio that you have, is that acceptable? That's what you have. So one of the biggest differences that this is just experience over time and doing this for over 2 decades, went through '08, went through 2000, and I just asked myself, there must be a better way to do this. So we've modeled our firm after kind of an endowment model. How would you like to be able to invest your money like a $23 billion endowment like Yale? And what they do, which I've learned from, is they use other assets besides stocks and bonds. They'll use real estate. They'll use other alternative investments. And so we've kind of taken that lead and said, hey, how can we build portfolios this way to where we can help not only reduce risk, but really over time increase return. I mean, to give you an example, during the tech wreck, they call it, from 2000 to 2002, the market lost about 40%. So let's say you had $100,000 invested in 2000. By 2002, you had $60,000 left. Now, if you invested with Yale, with their endowment portfolio, they owned about 30% stocks. They had very little bonds. They owned real estate, some other non-correlated, non-stock and bond assets. They were up 41% in 2000 when the market was down 10. They were up 9% in 2001 when the market was down 13. They were up 7% or 0.7% in 2002 when the market was down 23%. Now, if you had $100,000 invested during that same time frame in the market or with Yale, with your own portfolio, you'd have about $60,000. Had $100,000, lost 40, you have $60,000. With a Yale portfolio, you'd have $164,000. I mean, it's life-changing. It's huge. I'm not saying we're going to be able to get returns like Yale Endowment, but the point is that we are going to build portfolios the way they're built because we're going to use other asset classes besides stocks and bonds. And today we're going to talk about real estate because real estate is a big one. Real estate is one of the basic portfolios strategies, we call them, that we use. So let's just say instead of having a 60% stock, 40% bond portfolio, you had a 30% stock, 30% bond, 30% real estate portfolio. I can tell you right there, I've cut your risk in half or more. Now, we're going to be more sophisticated in that, but the point is real estate, we're talking about hard assets. We're talking about something you can feel, you can see, because when we own real estate, we get cash flow, right? We get cash flow. We get income. We get some tax benefits from that as well, and hopefully have appreciation. So we're very blessed to have a gentleman on I've been working with for several years now Brian Nelson. He's the CEO, president, top dog, I don't know what you want to call him, of NB Private Capital. Now, they manage about $500 million of real estate, of student housing. And I'm really picky about real estate and really student housing because, the value of real estate, both in industrial, retail, Class A office are all just through the roof. It's hard to find value in good yield. So I'm going to welcome Brian. And Brian, are you there?
I'm here.
Oh, perfect. I'm glad we got our wires together, not crossed. So you sound good. Are you in Orange County?
Yeah, I'm in Orange County, and I feel more sophisticated just listening to that intro. It's fantastic.
Well, that's why you're here. See, you're a piece of our endowment portfolio, of our less risky portfolio. And I want you to introduce yourself and talk about your firm. But one of the main reasons that we use Brian and his firm, two things. We'll talk about a portfolio that he runs and why we use him and all the benefits. And we'll talk about 1031 exchanges for some of you that don't know what that is, but very, very important. So Brian, just kind of tell me about your firm and what got you into student housing and what the benefits are of student housing, why somebody should listen to us. Talk about this.
I think a lot of it is just what you started off with. When you sit down, back in 04, 05, I was coming out of MBA school. I had a Series 7 license. And as I started talking to investors and just finding out what they were looking for, they were very consistent. Those who were very affluent or just looking to put their money to work, very consistent. They wanted something stable. They wanted to sleep well at night. They didn't want to have to worry with the morning news cycle, how that impacted their portfolio. So they wanted the stability, but a lot of folks were looking for income, and they just had a really difficult time finding good income-producing assets that also would grow over time. And everybody wants the tax shelter, especially here in California. A penny saved is a penny earned. And so when you sit down and you talk to people and you start building that portfolio like you do, where you try to get this, okay, well, these are really tax-friendly and this is really growth-oriented. But what if you could find stability, income, tax shelter, and growth in one asset? And what if you could find that asset had an economic anchor, like a major university, some of the most stable institutions in the world, and college enrollment has shown no correlation to economic or real estate cycles over the last 40 years. So here you have something that offers all of these benefits. It's a brick and mortar asset, and it's diversified away from the economy and away from the rest of the portfolio, and it's anchored by something like the University of Notre Dame or San Diego State or UCLA that's been around for hundreds of years. It's not going anywhere. That's what got us into student housing. We fell in love with the balance of benefits because it resonated with what everyone else was looking for but having a difficult time to find, and it also had that ability to perform, especially when we hit recession, because as you know, more kids end up going back to school.
Right.
So that's really what got us into student housing in 05, 06. And so that it was really what it brought to the table in terms of benefits.
So tell me, one of the biggest things is that, what do you consider the difference between, let's say somebody owns a real estate mutual fund and from a risk basis and the student housing? Say we own a property at USC, Notre Dame, Ole Miss, some of the properties you own. What would you say the biggest difference would be?
Well, the biggest difference is the lack of cyclicality right off the bat. And a lot of people their first knee-jerk reaction for student housing is, well, what did you do during the summer? Kids go home for the summer. But what happens is those markets that you mentioned are so tight, and it's so hard to find real estate close to campus. So this is part of the answer. You picture a university that's been around for a couple hundred years. There's inherently just a finite amount of space around campus, but 7 out of 10 students will prefer proximity to campus as the number one thing they look for. So you have this predictability of, okay, well, if I'm within half a mile to campus, I'm going to typically stay full year in, year out, as long as that school's around, which, of course, those have all been around forever, seemingly. But what I like about the new model is so some of these markets are so tight that we require 12-month leases. So what happens now is we all know the school will start end of August or early September. That's very predictable. So we'll spend all off season, January, February, March, pre-leasing for next school year. So what typically happens is students will sign up, they'll have a 12-month lease. So even if they go home for the summer, we're still collecting rent on all of these properties, and then we'll typically have the properties pre-leased 2 or 3 months before the school year even begins. So we're always producing revenue constantly, and so it's very efficient business model. Unlike a retail, if a retail tenant leaves, you got to go out, hire a broker, pay him or her a big commission, put it into tenant improvements, and then you got to sign a 10-year lease, and then every year that goes by, that's one less year on the lease. It's way different with student housing, so it's a much more convenient and friendly model. And then what we do is we charge by the bed. So if we have a property that's 500 beds, we have 500 individual leases, and because we have that flexibility, we get the parents to guarantee the lease. So our tenant isn't the 20-year-old student who has no idea what a FICO score is. It's mom and dad, and mom and dad typically own homes. They have great incomes, and then we have 500 moms and dads. So our core revenue source is really well diversified. And so I think just all of those things that factor into that really make student housing pretty unique.
Well, that's we're going to take a break, Brian, and I want to talk more specifically about the fund because you have a diversified fund that we really like that owns about 20 properties, very, very diversified. Talk about individual properties. Also talk about how to exchange from existing real estate into student housing and why we'd want to do that. So this is David Reyes. We'll be back here in a minute with Brian Nelson of MB Private Capital.